Today we're going to talk about the lowest down payment options per program. Buying a house can be quite a daunting task, and of course having to save up for closing costs as well as down payment can be quite challenging. Today we're going to look at what the lowest down payment options are for conventional financing, FHA, VA, USDA, jumbo loans, as well as state housing initiatives to help lower your upfront cash. So stick around to the end and I'll show you just how to minimize the amount of cash that you need to bring to closing. Do you want to know everything there is to know about home loans? Then subscribe below and tap the bell for notifications so that you'll be the first to know when I release a new video. My name is Aaron Benton, host of this channel and local mortgage lender. I get calls and emails every day from people just like you looking for home financing advice. So whether you're looking to purchase in a week, a month, or even a year, click the link below to set up a call or video meeting so that I can understand your goals and tailor a plan exclusively for you. The first loan we're going to talk about is a VA loan, a very powerful loan, very beneficial to the client. It's not for everybody. The VA loan is for someone who is an active military, retired military, or a surviving spouse of someone who was in the military. So thank you for your service. You get a VA loan, which is very, very helpful. It allows for 100% financing. Ultimately meaning you do not have to put any money down. You will have to cover your closing costs, but if you stick around to the end of the video, I will show you a way to help strategize that. So 100% financing. And with 100% financing, you have a funding fee. Whether you're using your VA loan the first time or it's called subsequent use, you've had VA loans in the past. So if you've put down, for example, under 5% and it's your first time using a VA loan, then the funding fee is 2.15%. You roll that funding fee, if you will, into the loan. So you're financing greater than 100%. If you've had a VA loan in the past and you're putting less than 5% down, the VA funding fee is 3.3%. If you have used a VA loan in the past or it's your first time and you're putting between 5% and 9.99% down, the VA funding fee is 1.5%. And if you're putting greater than 10% down, then the VA funding fee is 1.25% of the loan amount. Again, doesn't matter if it's your first time use or you've used it in the past. It's called the subsequent use. Now, the funding fee can be waived. Not all military pay the funding fee. How do you get exempt? Well, to get exempt, you were hurt or injured, if you will, during active service. You were a Purple Heart recipient during active service, or of course you're a surviving spouse and you receive dependency and indemnity compensation. So you have the funding fee. Yes, not all people pay that. They do get waived based on their medical history, if you will. But VA loan, 100% financing, no mortgage insurance, and then there's potentially the funding fee. But a great avenue, especially in terms of minimal upfront cash out of pocket. So the second option we're going to talk about is conventional financing. This is probably known as mainstream financing at Fannie Mae, Freddie Mac, which is the government entity or the government arm, if you will, that securitizes mortgages. And this is a very popular product, and the minimum down payment for a conventional loan for a first-time home buyer is 3%. Now, what makes a first-time home buyer? Any person who has owned a home, or not owned a home rather, in the last 3 years is considered a first-time home buyer. Now, if you have owned a home in the last 3 years, then the minimum down payment is 5%. So if you haven't owned a home in the last 3 years, it's 3% down payment. If you have owned a home in the last 3 years, then the minimum down payment on a conventional loan is 5%. Now, there's also some additional overlay, if you will, where if you are making less than 80% of the area median income or 100% of the area median income, you can apply and qualify, if you will, for specialty products even within the conforming loan limits, or conforming loans, if you will. So there is a Fannie Mae Home Ready, Freddie Mac Home Possible, and there's also, like I said, this area median income loan. The area median income loan is only for first-time home buyers. Fannie Mae Home Ready and Freddie Mac's Home Possible are loans that are income-based, if you will. So they're not driven based on whether or not you're a first-time home buyer, but income-driven. And what makes these programs so special is that the down payment, yes, it's low. It can be 3% or 5%, depending if you're a first-time home buyer. You're also going to get an improved interest rate, so lower than somebody who makes a lot of money, if you will. And you're also going to see a lower mortgage insurance. Again, mortgage insurance is going to be based on your credit score, your debt to income. There are a bunch of factors. It's called risk-based pricing, and that is based on all the factors involved come up with a mortgage insurance number. Any person who puts less than 20% down on a conventional loan does pay mortgage insurance. And again, it can be done on a monthly basis. It could get financed into the loan, and it could also be paid lump sum. Now, majority of the time, you're going to see this conventional loan mortgage insurance is paid on a monthly basis. Once the person gets 20% equity in the home, the mortgage insurance will go away. So conventional financing, great option, 3% down. A lot of people don't actually think of that or know about it, but now you do. The third program we're going to talk about is FHA financing. So one of the biggest misconceptions is people think that FHA loans are only for first-time home buyers. That's not the case. Now, the minimum down payment for an FHA loan is 3.5%. You could put 3.5% down as a first-time home buyer. You could put 3.5% down as a repeat home buyer. FHA does have what's called an upfront MIP, and what that is it's a 1.75% fee that gets financed into the loan. So you don't have to pay it up front. You could if you want, but I've actually never seen somebody actually pay that upfront mortgage insurance. Now you could, but it gets financed into the loan and you pay on it through the life of the loan. A conventional loan, an FHA loan, is going to have mortgage insurance that will stick with that loan like a glove. And so even if you were to get 20% equity in the home, you're still going to have that mortgage insurance. Now FHA, unlike conventional financing, I said the mortgage insurance was risk-based. FHA, it's all based off of a percentage. So if you were to put less than 5% down, the annual mortgage insurance is going to be 0.55% of the loan amount, and then of course we divide that by 12 to come up with your monthly mortgage insurance. So there's actually two. There's the upfront mortgage insurance that gets financed into the loan, and then there's a mortgage insurance that you pay on a monthly basis, which again, the annual number is 0.55% of the loan amount, and then you divide that by 12 for the monthly figure. Now with FHA, should you put 5% down or more, the mortgage insurance factor is 0.5, not 0.55, 0.5. So you get a little bit of a break. And again, loan amount times 0.5, divide that number by 12, and that is your monthly figure. Now with FHA, some people ask, can I have two FHA loans or multiple FHA loans at once? Not always. FHA has very specific guidelines that pertain to maybe your family size is getting a little bit larger, maybe you had to relocate for a job, something along those lines. So the idea of, hey, I had an FHA loan and now I just want to upgrade, if you will, nothing happened to my family, I didn't get a new job, I just want a different house and it happens to be right down the street. You can't have two FHA loans simultaneously, if you will. Conventional, you can have multiple conventional loans. You could have multiple VA loans. FHA, though, you can't have multiple. So just a little insight on the FHA, 3.5% down. Not always, does not have to be for a first-time home buyer. Repeat home buyers could also put down 3.5%. So another financing program, USDA loan. USDA loan is 100% financing. It does come with what's called a guarantee fee. It's a fee just like VA has the funding fee, just like FHA has the upfront mortgage insurance. The guarantee fee, a USDA loan, is 1% of the loan amount. You take the loan amount, you multiply it by 1%, you have two numbers, add them together, that's your total loan amount. So again, you can finance greater than 100%. USDA also has what's called a mortgage insurance, and you're paying that. It's 0.35%. And again, that's the annual figure. So you take your loan amount times 0.35%, divide it by 12. Now you have your monthly mortgage insurance that you're paying every single month on a USDA loan. Now USDA loans are great. It's 100% financing. It's just restricted geographically. They are meant for rural housing. And so for instance, like if you lived in Hilton Head, South Carolina, Hilton Head does not qualify for a USDA loan. It's not considered rural. So your mortgage lender will be able to tell you, hey, does this area qualify for a USDA loan? The other thing with USDA loans that makes it a little bit more challenging is they have a little bit greater restriction on debt to income. They have a little bit greater restriction on income. So there are income limits that you can't exceed. There's debt to income that you can't exceed. So a little bit more restrictive. Let me tell you, if it was easy for everyone to qualify, I think I'd be writing a lot more USDA loans with the 100% financing. But it's worth a shot. We can always explore it, but just understand there are some restrictions there that make it a little bit harder to qualify for from geographically speaking, and the debt to income restriction as well as the income restriction. But USDA, great product, 100% financing. Another loan product is jumbo loans. Jumbo loans are based on loan limit, and Fannie Mae and Freddie Mac, which is the government arm that securitizes mortgages, they put out a new loan limit, if you will, based on data that is found for average median home sale and median home sale based in Q3. Annually they do a composition of data and they come up with what the conforming loan limit would be. In 2025, the loan limit is $806,250. However, that number, like I said, can change every single year because of the new data and the home sale values, if you will. So jumbo loans, minimum down payment, I've seen them go as low as 5%, sometimes 10.1%, 20% gets you best terms. But loans that are greater than $806,250, depending on your lender, you're going to have different down payment options. Some have lower, like I said, 5% down. Others require 10.1. They might require 20% down. So it will change based on the lender in the jumbo space. Now, there's also these high balance areas, if you will, where essentially the loan limit is not $806,250, it's greater. And so that is just based on these high cost areas. So it's going to be based on the state, the county, if you will, to help justify that. But if I went nationwide, Fannie Mae and Freddie Mac's conforming loan limit is $806,250. Any loan greater than that is considered a jumbo loan. There are also state housing initiatives out there that help individuals with down payment assistance or closing cost assistance. A little local flavor, South Carolina has a bond program and a non-bond program. With the bond program, you would get $10,000 towards closing costs and down payment assistance. You'd have to live in the home as your primary residence for 15 years. If you do not, you'd have to pay that loan back. While you had that $10,000, again, it's just an upfront loan, if you will, that you do not have to pay on. If you go with the non-bond program with South Carolina, the down payment assistance is either going to be 3%, 4%, or 5%, and it's based on the original loan amount or the base loan amount, if you will. So you would just, you're going to notice a difference in interest rate, if you will, based on whether you get 3%, 4%, or 5% assistance, but a really good option or a way to help lower those upfront costs. These state housing initiatives are second mortgages or second liens that will help. Basically, you take a conventional loan, an FHA loan, a VA loan, or a USDA loan, and you stack this state housing initiative on top of it, and that ultimately will limit your total cash to close. Okay, so you made it to the end. And like I said, your goal when you're buying a house is how can you minimize the amount of upfront cash that you have to spend. You're trying to limit what's going out, maybe keep a little bit of a nest egg, but what you're gonna have is you got your down payment and you got your closing costs. Those are two separate buckets, closing costs and prepaids. And we've just gone over what the minimum down payment is for every program. We've also talked about state housing. That is a second loan, if you will, or a second mortgage that can help with the down payment assistance. A lot of different requirements. Not everyone would qualify, if you will, for state housing because they have income limits, they have debt to income restrictions. So not for everybody, but we've covered these low down payment options per program. Now, how do I ultimately lower my total cost? We have our down payment, which is going to come from either the client, the buyer, if you will, or the borrower, and it can come as a gift from a family member. No matter how you cut it, it has to come from the borrower or a family member. Now, closing costs, those can be paid by the seller. That would be handled as a negotiating strategy. So when you're negotiating, you can always ask, I want the seller to pay $5,000 or $10,000 worth of my closing costs, or whatever number you decide. Now, again, it's part of closing costs. It's part of your strategy, if you will, with negotiating. So don't expect the seller to just roll over and say, oh yeah, of course we'll give it. You're probably gonna see a little bit in terms of maybe a higher purchase price because they're giving you a closing cost credit. But whether the seller is lowering their purchase price, or their sale price rather, or they're gonna give you a closing cost credit, it's still netting out to be the same bottom line to the seller. There is no disadvantage for the seller to give you a closing cost credit. There are limits based on the program, whether it's conventional, VA, FHA, USDA, there are restrictions. But nevertheless, you talk to your lender, you build a plan, and together you can initiate this offer that is gonna not only help you understand your total cost to close, but you can limit your total out of pocket. So keep that in mind when negotiating, and thanks for sticking around. Thanks for sticking around to the end. I hope that you enjoyed it and found it informative and somewhat helpful. Of course, I'd love to connect with you so that I can understand your goals and tailor a financing plan exclusively for you. To do so, click on the link below to schedule a call or set up a video meeting. I hope to one day get to connect with you, but if not, I hope to at least see you on the next video.